Okay, Daryl, now what I want to talk to you about is your self-managed super fund. And so what we'll do is we'll roll 150 grand from Rio Tinto into the Daryl self-managed super fund, and with that your employer's going to be putting in their 9% or whatever they're putting through for your contributions on that monthly basis into this self-managed super fund. So it's just, think of it as a company in your name, and it's got a bank account. That bank account has got 150 grand in cash in it. What would you do with 150 grand in cash? Well, no doubt you'd probably look at a property. With that, the bank will lend you a self-managed super fund 80% of the value of the property. So if you want to buy a 500 grand property, they're going to lend you 400 grand. What that means is you're going to put down 100 grand deposit, which you've got 150 grand cash. You use 100 grand of that to put down as the deposit. The rent for the investment property gets paid into your self-managed super fund. It's got a 15% tax bracket on it, which is fantastic, a lot lower than what you're currently paying. And you've then also got the mortgage being paid by the self-managed super fund. So there's no money actually out of your pocket. It's all being paid by the super fund, and all the rent comes in and all the mortgage expenses go out. Two ways to create wealth I've discussed with you was leverage and other people's money. We're using other people's money here because you're only putting down 100 grand, but what you're doing is you're getting a $500,000 asset, and that's leveraging it up. And what I mean by that is that you're going to get a 10% gain, for example, on an investment property. That means you're going to get 10% on 500 grand, which would be a $50,000 return. Whereas you've got a 10% gain on your current super, that's a 15 grand return. 50 grand versus 15 grand, huge difference there. The best part about this is with that self-managed super fund and the property it actually owns, is there's no capital gains tax on that property if you sell it at retirement. For example, you buy it for 500 grand today. By the time you retire, it's worth $1 million. With that $1 million, you've made 500 grand in gain. The capital gains tax on that 500 grand is 0%. 0% capital gains tax on that investment property if you sell at retirement. A really good strategy, something where you can utilize your superannuation a lot better. I can help set that all up for you and get that up and running.